Global business used to be a topic by itself, but I guess the people at the Border Studies found that it was a little strange to look at global business as being separate from all other businesses, because global businesses, could be small businesses. They could be small import-export businesses in Australia, and just saying, all right, there are only these great big global giant businesses is not really true anymore. Because Australian businesses, they import, they export, they also get money from overseas, sometimes by borrowing, sometimes by equity. They get overseas investors. So what happens in global markets around the world is going to influence financial management here. The three main things in the syllabus are the economic outlook, so what economists, generally economists, and then therefore newspapers, and then therefore the readers of those newspapers, so what economists think about the future of the global economy is going to affect the availability of funds, so can we get money from overseas? And at what price? So the interest rates. So the yellow boxes there, those are the syllabus dot points: economic outlook, availability of funds, interest rates. So what economists think about the future of the Australian economy is going to affect whether we can get money from overseas and at what price, right? So in terms of the economic outlook, there is that relationship. But the global economic outlook has this more direct effect. It's not just, do economists think, that doomsday is coming, so no one's going to lend us money. It also has a direct effect on the demand for Australian exports. So if there's a negative outlook in the rest of the world, then there's going to be less demand, right? So people are scared about the future, so they stop buying. There's nothing wrong with our products. It's just that they're worried about the future, so they're not going to spend the money that they don't necessarily need to spend on our products. It's going to lead to less demand for those products. So there are those two big relationships there. There's, can we get the money? How much do we have to pay for money? But then also, for our exports, are we actually going to be able to sell them? And it's really nothing to do with, your business. It has to just do with the global economic outlook. In terms of the availability of funds, Australian businesses do need money to expand, but because we don't in Australia have enough money for every business loan, sometimes you have to get it from overseas, especially for large companies. But if the overseas lenders stop lending, then there are less funds available. If banks in the United States have decided, right, we're not going to lend money anymore, especially overseas, because it's too risky, because we've been screwed over before, whatever. If they're scared of not getting it back, then that is going to have an effect on how many dollars are available for Australians that need money to expand, for Australian businesses that need that money. Another strategy that you can kind of employ in that situation is try to use equity for expansion. So try an IPO, try to sell shares to people locally rather than get money from overseas if they're not making it available. Sometimes they decide, look, we're not going to make funds available to global borrowers for the next 3 months. We'll see how we're doing, and they can change their policies, and they're absolutely legally allowed to change their policies based on what the global economic outlook is. But if it goes on for too long, like the global financial crisis, you've got a situation, like ABC Learning, which just couldn't get the money anymore because they just kept refinancing their loans from different countries, and eventually it stopped. The availability of funds, ran out. The interest rates are kind of connected there, because sometimes it seems like a good idea to borrow overseas because the interest rates are lower than ours. So if you look at overseas interest rates and you go, wow, Japan's interest rate is 0.25%. Right? It's basically zero. It's basically free money. It does seem like a good idea. Okay, I'm going to borrow from over there. You're not actually going to get it at 0.25%. That's the official interest rate. But they can change. The interest rates themselves can change here and they can change there. So, your advantage might disappear. If you're borrowing money from overseas because it's a 0.5% interest rate difference, that it's 0.5% lower over there, it's really not worth the risk because the interest rate might change. If theirs goes, up by 0.25 and ours goes down by 0.25, you might as well just get the money locally. And it's really not worth the risk because there's this extra risk that the exchange rate might change, which is going to increase your payments. Without you doing anything wrong, without the overseas bank or the overseas investor really doing anything bad, you are going to have some problems because the exchange rate is going to automatically hurt you. Right? It could work in your advantage, like the exchange rate might get better for you, but to stop those things from happening, you need to do things like hedging. and we look at this a little bit later, interest rate hedging, exchange rate hedging, that's the big strategy, and that's a key word that you need to have, in all of your answers that have to do with any sort of global market influences. Even if you don't understand what hedging is, just say they should do hedging. They should get involved in hedging, interest rate hedging, or exchange rate hedging, because people that talk about hedging and hedge funds just automatically sound smarter. So you do need to have that as the strategy to use here.